Pause for a moment and think about this carefully. Every major financial crisis feels sudden when it finally hits the headlines. But when you look back with clarity, none of them were sudden at all. They were slow, they were visible, and they were driven by structural forces that built up over years, sometimes decades. That's what this video is about. Not politics, not personalities, not promises. This is about why the next major downturn, which many analysts expect to center around 2026, is structural in nature, and why no single leader, including Donald Trump, can simply stop it once the pressure reaches a breaking point. To understand this clearly, we have to follow the data step by step, without emotion and without distractions. First, we need to understand a basic reality about markets. Presidents do not control economic cycles. They inherit them. By the time any president takes office, the most important variables are already locked in. Government debt has already been issued. Long-term loans have already been written. Interest rate structures are already in place. Global capital flows are already moving. Policy decisions can influence timing and severity, but they cannot erase the underlying math. This is why financial crises repeat across different administrations, different parties, and different ideologies. Markets respond to balance sheets and incentives, not speeches. Now let's move to the foundation of the current problem. U.S. national debt has crossed into the mid-$30 trillion range. That number matters not because it sounds dramatic, but because of what it does to the system. At this level, debt becomes a constraint. Interest payments alone have become one of the fastest growing expenses in the federal budget. This creates what economists often describe as a fiscal trap. Here's how that trap works in real terms. If interest rates remain high in order to control inflation, government interest costs rise sharply. If rates are cut aggressively to reduce those costs, inflation pressure returns, and long-term bond yields tend to rise anyway as investors demand compensation. If spending increases to stimulate growth, borrowing expands and bond markets demand higher yields. If spending is cut to reduce deficits, economic growth slows and tax revenues weaken. Every option creates pressure somewhere else. This is not a political failure. It is arithmetic. At high debt levels, policy flexibility shrinks. Choices become limited and trade-offs become harsher. For decades, many people believed the United States could simply grow its way out of debt. And for a long time, that worked. Economic growth outpaced debt growth. Productivity expanded. Demographics were favorable. Global demand for U.S. assets was rising. That dynamic is changing. Productivity growth has slowed. Demographics are aging. And a growing share of economic growth itself is supported by debt. When debt compounds faster than productive output, the system doesn't collapse immediately, but it becomes fragile. Fragility matters when stress arrives. Now let's move to the second major pressure point, commercial real estate. Between now and 2026, more than $1.5 trillion in U.S. commercial real estate loans are scheduled to mature and require refinancing. These loans were issued in a very different environment, near zero interest rates, higher office occupancy, and higher property valuations. That environment no longer exists. Office utilization in major cities remains structurally lower than before 2020. Property values have adjusted downward. Refinancing now happens at significantly higher interest rates. This creates a simple but dangerous mismatch. Many properties no longer generate enough cash flow to refinance under current conditions. When refinancing fails, defaults do not explode all at once. Stress builds quietly. Banks extend terms. Losses are delayed. Balance sheets weaken beneath the surface. Commercial real estate is deeply connected to the financial system. Regional banks hold a large share of these loans. Pension funds and insurance companies are exposed through structured products. Commercial mortgage-backed securities spread the risk across institutions. The issue is not just losses, it is confidence. Banks operate on trust. When asset values fall while funding costs rise, balance sheets deteriorate even before defaults peak. This is how localized stress becomes systemic. Not through one dramatic failure, but through many quiet ones. Now zoom out to the global level. For decades, the US dollar benefited from overwhelming global demand. Trade, energy markets, and reserves were heavily dollar-based. That dominance hasn't disappeared, but it is slowly changing. More trade is being settled in local currencies. More bilateral agreements reduce reliance on the dollar. Central banks diversify reserves incrementally. This is not the collapse of the dollar. It is a reduction in marginal demand. And marginal demand matters. When a country must issue large amounts of debt while demand for its currency grows more slowly, adjustments occur. Long-term interest rates rise, inflation pressure becomes harder to control, monetary policy becomes less effective. Again, this is structural, not emotional. So why does 2026 matter? Because timelines converge. Debt servicing pressure intensifies. Commercial real estate refinancing peaks. Bank balance sheets face delayed stress recognition. Global capital flows continue adjusting. Fiscal and monetary flexibility narrow at the same time. Crises do not require a single trigger. They emerge when multiple stresses overlap. 2026 represents a window where those stresses align. Markets do not wait for certainty. They price probability. And probability rises when constraints stack on top of each other. Historically, downturns do not hit everyone equally. The most exposed are those with high leverage, limited liquidity, and heavy dependence on refinancing. Illiquid assets suffer first. Institutions built on cheap money feel pressure earliest. The system does not punish optimism. It punishes fragility. Those with liquidity, optionality, and manageable leverage tend to endure far better, not because they predict crashes, but because they are not forced to react under pressure. This is not a call to panic. It is a call to understand constraints. No president can refinance trillions of dollars in commercial real estate loans. No policy can instantly undo decades of debt accumulation. No leader controls global capital flows. Markets do not break because of bad intentions. They break when incentives stop aligning and math stops working. This is not about fear. It is about clarity. History shows that financial stress builds quietly, then reveals itself suddenly. Those who understand the structure early do not panic later. And when the noise gets loud, clarity becomes the only real advantage left.